Welcome to Mortgage and Chill Mondays. My name is Fred Chilton. I'm a mortgage broker here in Austin, Texas. I've been doing mortgages for close to 5 years now, and I wanted to give you a breakdown of what the 2-1 buydown is. Now, by this point, you may or may not have heard about the 2-1 buydown, but what exactly is it? In this video, we're gonna briefly touch on that, but you're also gonna walk away with a lot of knowledge, knowing confidently what that is and why it could be beneficial to some people. Before we begin though, please do me a favor, subscribe, turn on the notification bell, and let's get started. So the 2-1 buydown has actually been around for a couple decades now. It's not a new product. It's just become more popular because rates are higher than normal. They're actually the highest they've been in about 14, 15 years or so. The reason it's called a 2-1 buydown is because you're paying on a lower interest rate those first 2 years. So for example, year one, you're gonna be paying on an interest rate that's lower by 2% than the going market rate today. Year two, you're paying on a lower interest rate than the going market today. Years 3 through 30, if you do not refinance, you're back to square one. You're just paying what you'd be paying today. So let's actually dive into a quick example of how this works so that you have actual numbers in hand. Okay, let's take a look at this example that I made for one of my clients. This was about a week ago. Please do note that this is not an actual rate quote. Rates change an absurdly annoying amount of times every single day, sometimes like 8 to 10 times per day. So do note that this is not a rate quote, this is not a pre-qualification, this is not a pre-approval. If you want that or if you have any questions, contact me, I got you. So let's use an example of $600,000 for a purchase price, which is, I feel like, a good amount here in Texas and Austin specifically. I know for my friends over in California, this is like the price of a shack made out of a cardboard box. So just play along, you'll get this. But I put 3 scenarios down. This is how I like to look at it. One scenario is with just coming in at list price without getting any concessions, without asking for anything. The other one is a price reduction. For example, $10,000 price reduction. See how that does or what that does for you. And then last but not least, I want to talk about the 2-1. Let's run through this real quick. On the left side, as of last Thursday before the Fed announced their dang job reports, but the interest rate was around 5.75% with a 6.226 APR. So there is a point in buy down associated with this. But the total principal and interest, not including taxes and insurance, was $33.26 per month. So you see that on the left side here. No borrower savings, no seller costs or seller concessions, nothing. Mind you, these are all based on 740 FICO, under 45% debt to income. Now, option one, you and your realtor can go in and ask for a price reduction of $10,000. What does that do, Fred? The loan amount goes down by about $9,500. You don't get a change in interest rate or APR, it's all the same. Your total monthly P&I, or principal and interest, drops to $32.71. $55 savings per month. I mean, great. You're going to cover some Netflix bills and maybe a burger or two. It doesn't do anything for you. It costs the seller, or you really, $10,000. Because in my opinion, that's not the best use of money. What is and what has been useful lately has been this 2-1 buydown that we're talking about, which is on the right side. So let's just say we do the same thing, but we offer full price at $600,000. You and your realtor, once again, talk to your realtor. They're the pros here. I'm just the numbers guy. You and your realtor ask for a $10,000 concession, because it does have to come from the seller for the concession for the 2-1 buydown to work. And this is what that looks like. So effectively, with a 2-1 buydown, remember, you're paying on an interest rate 2% lower than the going market rate. So at this time, 5.75 was the going market rate. So here you're paying at a 3.75% payment. This is the cool thing. Year one, your principal and interest drops to $26.39 per month, which is a $690 savings per month. Year two is a little bit lower than that, but the end result is that you still get the same $10,000 seller concession that you would have got from a price reduction here. So at the end of the day, it's a win-win for both parties. Now, a couple things to note about the 2-1 buydown is that A, you are being qualified on the full note rate, which is, for example, today, let's say it's 6.75% with an APR of 6.9. You're being qualified on that 6.75. It does not mean you're being qualified on an interest rate that's 2% lower than what that is. Another note to make is that this has to come from a seller concession. The buyer cannot prepay that for themselves, as awesome as that would be. So this has to come from a seller concession, but let's just say you do refinance within those first 24 months of having this loan, you'll get a prorated amount of that seller concession back towards your mortgage payoff. So in a sense, it's a win-win situation. It future-proofs your loan. It makes sure that you get your ROI when needed, and you don't lose money if rates drop in the next 6 months. Again, this is Fred Chilton. I'm with Austin Mortgage Lending. Please do me a huge favor. Give me a follow. Leave a comment. If you have any questions or topics that you want me to cover, also ask me in there. I am very responsive, and I'll see you next time.